Welcome to the long-term cash presentation presented by Nichols Associates. The federal government recognized the growing importance of long-term care services as the largest looming unfunded liability facing the baby boomers generation, and as a result, passed significant legislation to encourage taxpayers to take responsibility for their own long-term care needs. The IRS passed the Health Insurance Portability and Accountability Act of 1996 to improve and promote access to long-term cash services. The HIPAA legislation states that long-term cash policies are treated as health and accident insurance contracts. This allows the premiums to be 100% deductible. This also allows the benefits received to be totally tax-free. The IRS has also determined that long-term cash as an employee benefit does not have to follow traditional ERISA guidelines. This means the employer may pick and choose who may participate in this benefit plan. On January 1, 2011, the CLASS Act became law. This is the federal government's way of trying to promote long-term care plans through payroll deduction. This act will only cover services that are performed at the home of the insured. This long-term cash plan allows the corporation to move corporate dollars into the hands of key executives totally tax-free. What are the methods of funding long-term cash benefits through an employer plan? The first is voluntary. This allows the employer to offer long-term cash benefits to the employees at no cost to the employer through payroll deduction. The second is a contributory plan. This allows the employer to fund the long-term cash plan for select key executives. And the third is a combination of the two. This allows the employer to participate in the cost with the employees. How do you qualify for benefits? The qualifying process is the ability to perform 2 out of 6 ADLs or any cognitive impairment. ADLs are the things we normally do in our daily living, including any daily activity we perform for self-care. They are bathing, toileting, dressing, eating, transferring, and continence. What are the advantages of offering long-term cash through an employer plan? The premiums are deductible as a business expense. The program allows the employee to purchase the plan during high-income earning years. The employees have the ability to include their spouse. There is no imputed income for plan participants. Benefits are received tax-free. The IRS permits discriminatory participation. Employers offering long-term cash can compete in recruiting and retaining talented workers. Employers can use the program to reward key employees that are productive and loyal. Employees are taking advantage of simplified underwriting. Benefits paid out to an employee can be restored in as little as 6 months. And the best part of the program is the return of premium, which refunds all premiums paid. Do employees need long-term cash? Disability benefits only cover a portion of an employee's salary. An employee will lose approximately 30% of their income, and there's a good chance that the benefit paid out will be taxable, reducing the benefit further. Plus, disability benefits stop if an employee leaves employment or is no longer working full-time. And when an employee retires, the disability plan ends when we need it the most. As an example, let's look at an employee earning $40,000 per year that suffers a catastrophic disability. Under a typical disability plan that replaces 60% of an employee's salary, they would only receive $1,400 per month. How would an individual pay their mortgage, their children's education, their normal household expenses, their automobile payment, and additional medical expenses that are not covered under their health plan? Simply put, long-term cash is the only product that protects you in your earning years, offers you total protection when you retire, and provides a death benefit with return of premium. Imagine receiving up to $12,000 per month when you need it the most. The choice is yours: long-term cash.